Welcome back. We will be looking at the financial measures now. As far as this chapter is concerned, there are a group of measures that, as you can see on the screen, that are being looked at, that are being considered as valid or most valid to measure performance of a company. That's gross profit and operating profit, including the margins, ROCE, return on capital employed, earnings per share, EBITDA, earnings before interest, tax, depreciation, and amortization. So those and liquidity and gearing indicators, right? The ratios. These are the ones that are used in order to evaluate the performance of a company. In addition to that, we have NPV, IRR, and MIRR, marginal internal rate of return, as the measures that we briefly touch on and understand in the context of projects, investments, the various projects that the companies undertake. So remember that. Um, let's quickly recap the ratios. Okay, so there we go. So as you know, the ratios, you have used them consistently. It would be quite foolish of me to do a F3 lesson here. On ratios, gross and operating profit, you know exactly how those are calculated. They're easy to calculate, widely understood, ignores largely the uncontrollable figures like tax and interest, and it can be calculated as a margin for comparable purposes. However, the disadvantages is that they have poor correlation with shareholder wealth because the distance is quite long. Shareholder wealth is essentially capital gains, which is something that is coming from the MPS gain and the dividend, right? So exactly how top line gross profit and operating profit translates into that, that relationship is a little weak. The next ratio is ROCE, return on capital employed. So you're basically taking the entire operating profit of the company and dividing it by the capital employed and converting it into a percentage. Operating profit divided by capital employed. It's also very easy to calculate. It measures generally how well a firm is utilizing the resources invested in it, because you are looking at the operating profit generated as a proportion to the capital invested, both debt and equity. You can calculate only debt, only equity. All of that can be done. So there are tweaks. There is much flexibility with the ROCE figure. You can calculate ROI, ROA, RONC. All kinds of ROs can be calculated. However, again, as a ratio, as a financial ratio, there is poor correlation with shareholder wealth. It can be distorted by accounting policies, and it can lead to possible dysfunctional behavior and or a cutting back in investment if it is used as a performance target. Now, in your study text, there are actually a few examples of how um, ROCE can be used to manipulate, because it's a percentage figure. So a very small company could be compared to a very large company, and the ROCE figure can be used to misrepresent the situation. So you can try this. There are a few other examples as well. I may be sharing some exercises with you. So if you get access to those, because now the focus of the new APM syllabus upgrade has actually deviated from the calculation side, and it's more focusing on the critical evaluation aspect. So it's really not something that needs your attention that much. But just make sure that you have a good grip of what the ratio is used for, what's good about it, what's bad about it. EPS, earnings per share, is essentially the difference between profit after tax and the preference dividends. That is anything that you have committed already in terms of dividends. So you get rid of that. So your pure net um, profit after tax, right? Even after removing the preference dividend portion, and you divide it by the weighted average number of shares in issue, and you get the earnings per share. Per share, how much actual money, actual gains, actual profits have you earned, out of which you can take any amount of money as dividends. If you want, you can give the whole thing as dividend. Your entire EPS can be your DPS. But obviously, that might not work well for the company and its future. But this is the ratio. It generally calculates how much or per share, the per share distributable wealth for the shareholders. It's easy to calculate, and it precisely is calculated, and the way it's calculated is defined by accounting standards. So there is a dedicated accounting standard that defines this EPS ratio. So it's widely accepted. There's a universal norm to it. However, again, it's still correlated to shareholder wealth very poorly, because a lot of figures, taxing, taxations, accounting, interest, all of that has affected that profit after tax figure that you're using. So because of that, there are many issues that you get in the EPS that doesn't really reflect a pure net figure, and therefore, and that is what this second point means, that accounting treatments may even distort. So if you want to, you can further tweak the figure by bringing in more accounting distortions. That brings me to EBITDA, earnings before interest, tax, depreciation, amortization, and write-offs like goodwill. It's a measure of underlying performance, since it is a proxy for cash flow generated from operating profit. So it's a very close figure to the actual cash flow. And end of the day, that's really a good read. So there's that benefit. It ignores tax and interest, since they are externally generated and therefore not relevant to the underlying success of the business, because tax and interest are not directly correlated to the business and its performance. So in that case, what you're doing is you're removing that effect. Even though you have to pay tax and you have to pay interest, you're considering as if, what if you don't pay them, and what is actually going on, how much is actually your performance bringing in. It's easily calculated, very common, very easily understood. And it also gets rid of depreciation, amortization, this kind of non-cash flow, assumed irrelevant cash flows from the figure, to keep the number clean as possible. So as far as an accounting measure is concerned, it's not a bad figure. Still, the way you recognize revenue and all of that can have or can impact the way it's connected to shareholder wealth. The comparison between organizations can be difficult because of the differences in accounting policies and the calculation of an absolute figure, because different companies can use different policies. And because of the inconsistency of that, when you get two EBITDAs of two different companies and you try to compare those, um, they might actually be incomparable or uncomparable, because they're not consistently developed. It can be easily manipulated by accounting policies in any case, because it's derived from the income statement, and it also ignores changes to working capital or the amount of non-current asset replacement needed. So you're purely working out of an income statement figure, and balance sheet impacts such as these are ignored in the EBITDA. So you can check it out. There are other profitability measures. Of course, EVA, we will be looking at it separately, but these measures, maybe just to recap, dividend cover, dividend yield, the PE ratio, price to earnings multiple, earnings yield, and the return on equity, purely the profit after tax over average shareholders equity. So these are other ratios that you have at your disposal, in addition to all the other ratios that you have learned and that and that you can use. Now in the exam, you have to be very careful. It's very unlikely you get to calculate ratios. That's not a department related to APM. But what happens here is that you may get calculated ratios. They may give you the numbers, they may give you the workings. And one, you might have to evaluate whether the workings are correct. So there are many examples. A famous example is the Iron Chicken example, where in 2016, I believe, if I'm right, where an incorrect EVA calculation was provided, and the students had to really assess the situation and provide feedback as to why it was incorrect, and offer corrective advice. So that is the sort of situations. Or there could be situations where a performance dashboard is given with these ratios, and they're actually not using the ratios well. That is the picture that is painted, and you're supposed to be the one who reviews that situation and says, these are the things that they're doing wrong, these are the ratios that they shouldn't even be looking at, and these are the ratios that they should actually be looking at, and this is how you can actually manage performance and improve performance. So that is the kind of critical angle that APM students are expected to have. Okay, so on that note, we will be moving on to, so in your study text, of course, all these ratios are there, you can try out. We will be moving on to liquidity indicators. Essentially, it's that the ratios, they measure the ability of the company to meet the short term obligations. obligations, not necessarily, targets or various milestones on book or on paper. It's the obligations. When you say obligations, it's, receivables, payables, that sort of thing. Who do you owe money? That sort of thing. What kind of checks do you have to bank? So usually what happens is that there is a challenge of managing both the cash aspect and the profitability aspect. There are companies that can be profitable on paper because they have large receivables, but they have very poor liquidity positions, because most of their sales are in credit, over trading. So unless a company is carefully managing its working capital, liquidity can erode, and a profitable company, if poor liquidity, if their liquidity is poor, can be a bad position. It's better to be a strongly liquid company, but not overly, but strongly, than, maybe and little profitable, right? This is why most of the companies that we see that are run on cash, that have over the counter cash transactions, immediate transactions, are doing really well, because their liquidity position is very strong. They have very short receivable days, or if not any, but they have extremely long payable days. So they get their money immediately, but they pay very late. So this actually creates an excess amount of interest return for the time they are holding all that cash, and gives them more room to expand and, create more business. So you have ratios like current ratio, the current assets over current liabilities ratio, acid test, taking out inventory, inventory period, raw material period, work in progress period, finished goods period. So all of that, receivables period and payables period. How long out of the cycle, how long do you take to pay your money? How long on average do you take to get your money that is owed to you? So these are all different ratios that are available for you in terms of managing liquidity. And before we move on to the next segment, the final set of ratios that you have is the gearing related ratios. They essentially, in particular, they focus on the company's ability to meet its liabilities. In fact, they focus on the debt aspect. So financial gearing is, it can be total gearing, where you're looking at long-term debt plus preference share capital over shareholder funds, or long-term debt, preference share capital over. So it's debt over equity or debt over debt plus equity. Simple, right? Debt over equity or debt over debt plus equity. This is what is used. You calculated WACC at some point. Operational gearing is more in the short term aspect, where you're more looking at the fixed to not you're not looking at the debt to equity ratio, but you're looking at the fixed cost to the non-fixed or the variable cost aspect. So how much, because your fixed cost commitments can be actually very troublesome, right? And they must be honored. So that kind of environment can be really challenging. It essentially measures the level of business risk relating to how fluctuations in volume might lead to falling profits, as fixed costs are not covered, right? That's why I said they can be burdensome, because you have to honor them. So despite whether you sell more or sell less, you have to pay your rent. You have to pay that fixed component of your communication bills, or power or electricity, or all of that, and your employee salaries. So all those fixed overheads and fixed costs have to be honored, whether you sell 1 unit or 100 or 1,000 or 5,000, doesn't matter. So that is what operational leverage actually calculates. The simplest form you can use it is to divide contribution, that is revenue minus variable costs contribution, from profit before interest and tax, to see exactly how much variability you have in your returns. Generally, if the contribution is large and the PBIT is low, then the fixed costs are only being marginally covered. And a small loss of revenue due to reduced sales volumes could lead to losses. So you have to be really careful in the situation that your profit before interest and tax is very low, because the distance now, your contribution is what it's is what is available for you after you take care of the cost of sales, right? Your variable costs, whatever you spend to generate that revenue. So contribution is what you have. Now, out of this contribution, once you deduct all the other expenses, the fixed expenses, if you're left with little money, then this can be really challenging. However, in contrast, what you need to do, or what you have to try and do, is you have to make sure that your PBIT, profit before interest and tax component, is actually as high as possible. That is, um, the contribution, profit before interest tax is the contribution after operational costs, right? So you have to have enough money to cover your operational costs, and then some to cover your fixed costs, right? That is the best situation. So it's something that you can actually manage from the top line by tweaking the margin also. Having very high margins can lead you to getting a good contribution, but it's not very easy, right? To sell very high priced products. So if you expand the margin too much, consumers will also have trouble buying it, which is why all these, what I see generally here, these sales days, Christmas sales, holiday sales, vacation sales, Boxing Day sales, that and this are booming, because the profit margin is kind of felt lower. But when you actually look at the costs of the real costs of these products, still the margins are more than enough to deal with the operational gearing in a healthy way. That's the trend I see with retailers in Canada. Interest cover is another ratio that you can use. Essentially, it's how much money you have to cover your interest. So again, we are looking at risk ratios, which is essentially your power, your ability to service the debt obligations. So this is a very good ratio, because if your PBIT is 2 million, or rather, if your PBIT is, let's say, 100,000, and if your interest is 10,000, it means that your interest cover is 10 times, right? 100,000 over 10,000, 100,000 divided by 10,000, it's 10 times, which means you're making 10 times your interest to cover your interest money, which means after you settle your interest, you have 9 out of 10 of that money left over. So that's a very strong position to have. But that all depends on your company and its own number. So these are the ratios that you can keep in mind. We looked at profitability ratios, liquidity ratios, and um, risk ratios. As the arsenal of ratios you have, pick the right ones, evaluate them well, be critical about them, know how to recommend and advise companies and the examiner as to what kind of right direction they should take. Thank you so much. See you soon.